Let us begin. My name is Darren Joseph, HJ Tax. We're a team of cross-border tax advisors that seek to demystify the sometimes confusing world of international tax for those of us who are trying to live that international lifestyle. Today, we have the honor and the privilege of speaking to the one, the only, Mr. William Fung. Bill, would you like to introduce yourself?
Thank you. Again, my name is William Funk. I'm a tax attorney, member of the firm Norris McLaughlin, and I do. I have a fairly broad tax practice, which covers such things as cross-border, tax planning for corporate transactions, as well as partnerships, personal matters, state and local, and I also deal with civil tax controversy. So it's a fairly broad tax practice.
So how does having substantial holdings in foreign companies impacted by U.S. taxes? We're really talking about PFIC, so maybe you can talk a bit about having substantial holdings in foreign operating companies.
Well, this starts to get to such things as controlled foreign corporations, and the principle is that if there's a corporation in which that is more than 50% owned by U.S. shareholders, and U.S. shareholders is a particular definition. U.S. shareholders, a U.S. shareholder for this purpose is a U.S. person who owns 10% of that foreign corporation. So that if you have, for instance, 1,000 completely unrelated U.S. holders of a foreign corporation, the foreign corporation has a real business. Basically, 1,000 U.S. investors in Pfizer and in Germany, that's not going to trigger these rules. But it's that when you have small numbers, such that figure 5 or fewer. That's how you get to the 50% U.S. shareholders that that there are concerns about U.S. people essentially receiving income, having control of income, and without being taxed on it. And for years and years, as long as that income was active, that wasn't taxable in the U.S. and that it was this category of subpart F income, which is passive income plus income from certain related party transactions plus income that had certain taints of foreign illegality, that these had to be immediately reported and taxed in the United States, but everything else could mount up. But the law was changed in 2017. It was such that all those amounts that had been built up were subject to a transition tax that was, if I remember the numbers right, it's sort of like 8% on illiquid assets and 17% on liquid assets, but it's a lower percent than usual. That was sort of in exchange for that all of this previously untaxed income or previously taxed deferred income was then finally being caught up, and now that there are two categories of income that flow through. So subpart F, again this passive or disfavored income, and then at the other end is what's called GILTI income, which is a really awkward acronym for it, but it's Global Intangible Low-Taxed Income, and which itself is based on economic concepts. It's the concept being that that this is after the calculations that this somehow gets it an income that is derived from the value of intellectual property, but really that it's just about any kind of income that is that's not subpart F, and so most things sort of pass through. There's certain exceptions that have to do with for instance, with taxation in high taxed jurisdictions, but but the operating assumption should be that that now all income of a controlled foreign corporation, that it's all going to have it's all going to have somewhere taxation. Somebody's going to tax it at at developed country rates, and so that's now the thing to be aware of.
Absolutely. So, I mean, again, to your point, some people fail to realize when you become that U.S. person, you're going to be taxing your worldwide income, and you have to disclose your worldwide investments as well. So part of that disclosure is, as you pointed out, if you have 10% or more in a foreign company, it at least requires disclosure. And once you cross that 50% as a controlled foreign corp, either on your own or by virtue of investing with other U.S. exposed shareholders, there may be actually taxes to pay, assuming that you're in a lower tax jurisdiction. So yeah, definitely something to consider. And people coming from other jurisdictions, they kind of, the questions that I get thrown at me would be like, well, hold on. It's not, yes, it's mine, but I hold it through some sort of nominee structure, which is pretty common in certain parts of the world to use nominee structure. But the IRS, they caught on to that decades ago because they've specified it's not just share value, but share value and voice. So even if you don't, if you're not an equity partner, if it's a debt stake or using a nominee, still there may be the disclosure requirements and certain other structures that may not technically be a company may just fall into these rules. And here we talk about foundations and other sort of civil law structures, which also require disclosure. So the point is that, when you speak with your preferred advisor, you put everything on the table and, you go through them one by one.
So if you're a 6, 7, or 8-figure investor, entrepreneur, or business owner who needs a tailor-made solution from a qualified team of professionals, we can help you achieve the international lifestyle, the freedom, and even the tax savings you're looking for. Visit us at htj.tax and live that international life.